Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, April 23rd, 2010. Let's start with the euro-dollar pair, where we saw some strong action as we saw the euro-dollar rally from 1.32 support up to 1.3399. That tested our 100-period moving average, and we stopped our rally there. The Greek government finally surrendered to the credit markets Friday, formally requesting the activation of a joint European Union International Monetary Fund rescue plan after soaring borrowing costs all week had pressured Greek bonds, which made it virtually impossible for the debt-strapped nation to meet its funding needs on the open market. Greece has 8.5 billion euros worth of bonds coming to maturity on May 19th, and this will eliminate any chance of a default on Greek debt, as it should get short-term financing from this aid package. So the euro did rally on that news after falling below its low on April 8th at 1.3280, and again we saw that our support at 132 today. While we may have a short-term bounce for the euro from the news, the overall picture could be considered a bad one, as we did have an EMU country that needed to go hand in hand in order to seek aid to avoid defaulting on its debt. So that's not a good outcome for Greece or for the EMU. However, with the short-term uncertainty hopefully taken care of now, if we have a smooth distribution of the funds, then we could see the euro see a bit of a relief rally perhaps in early next week's trading. Following the news, we did see a 10-year bonds a bit lower, as well as the spread between 10-year Greek bonds over German bonds narrow as well as the credit default swaps, which guard against default of Greece. Sovereign default. We also had some positive fundamental data from the Eurozone in the form of the IFO Business Climate Index for the month of April. So this is a bit of a leading index, and it shot up to 101.6, which beat expectations of a rise to 98.9. We had both the current conditions and the expectations index rising in the release. If you can tell from the charts to the right, blue here is the assessment of the business situation, and we see that in the last 2 months we've had a very strong rise from the 90 level up to almost 100. So this is a good sign for the largest economy within the Eurozone bloc of nations. A second report showed industrial new orders in the Eurozone for the month of February rise to 1.5%, which beat expectations of a 1% increase and makes up the 1.6% decline we had seen in January. On the year, new orders are up 12.2%. So those are some positive fundamentals to go with pretty strong flash manufacturing and services PMI data we had seen from the Eurozone yesterday. Turning to the pound-dollar pair, we saw it dip below the 1.5350 level, which had acted as support in Thursday's trading, hitting a low at 1.5294, but we did recover as we had some positive U.S. equities, and we moved this pair back up to 1.5371, which is clustered within our three main moving averages, 50, 100, and 200 period moving averages on the 1 hour time frame. The pound slid as we had some softer than expected GDP data, but it seems that the markets have discounted the weaker result, as it is a preliminary release, and we had some very poor weather in January, which worked to stymie growth somewhat. Here we take a look at that release, and we see that the GDP grew 0.2% in the first quarter, which was about half of the forecast of a 0.4% rise. As I mentioned, we had higher U.S. equities, with the Dow Jones up 70 points and the Nasdaq and S&P both posting positive increases as well. We had U.S. Treasury yields rise as Treasury prices fell, and the USD JPY pair moved above its resistance around 93.70 from 2 weeks ago, and hit a new high, a 3-week high at 94.31. That extended the gains for the pair that we had seen starting Monday's test of the 91.50 area, and we did have some consolidation midweek, but now we move upwards yet again in the pair. That could invalidate the downswing we have seen in this pair, as we broke above this downward sloping trend line, a resistance trend line, and we even pretty much used it as a test of support that held. We also bounced up from our 100 and 200 period moving averages. We had a couple of releases from the US. First, let's take a look at durable goods orders for the month of March, where the headline figure came in much worse than expected at negative 1.3%. But if we look deeper into the data, one component, capital spending, excluding aircrafts, which is a barometer for business investment spending, did rise 2.1%, so it was a positive from the report. The decline in the headline rate was primarily due to a sharp drop in transportation orders. In a second release from the US, new home sales for the month of March soared 26.9% on the month compared to February, when we did have a record low in new home sales. The annual pace is now at 411,000, which blew out expectations of a 326,000 reading. As we can see from the chart to the right, we had been in a downward trend in new home sales over the last 7 months or so, and that was broken by today's jump in sales. Sales are boosted by a soon-to-expire tax break, low mortgage rates, and favorable weather during the month. Now we take a look at the US dollar-Canadian dollar pair, and we see that during the early part of New York trading, the US dollar gained as we had some weak Canadian releases, which we will go over in a second. But after we tested above the 1.0050 level and we had some risk appetite in later New York trading, we did see the USD Canadian dollar pair its earlier gains and moving back below parity by the close of Friday's trading. We can lay down a couple of trend lines, and we see that we are in a bit of an upward sloping channel, where at first we tested the higher part of the channel, but then by the end of today's trading we were hitting close to the low part of that channel. So after a very strong move in favor of the Canadian dollar earlier in the week, we seem to be consolidating a bit around the parity level, which we have seen over the past several weeks. Taking a look at our Canadian data, consumer prices for the month of March came in rather weak, as we had a flat reading overall in the monthly change, while the annual rate fell to 1.4% increase. Core CPI, meanwhile, was down 0.2%, with the core annual CPI slowing to 1.7%. So overall, very weak pressures on consumer prices. A second report, retail sales for the month of February, showed a 0.5% increase on the month, with core sales, however, down 0.1%. Both figures were slightly lower than expectations, but at least the headline rate did increase for the third straight month. The Canadian dollar was boosted in New York trading, as we also had oil rising rather sharply to end the week, up 1.6% or $1.39 to above $85 a barrel. So higher oil prices tend to favor higher Canadian dollar, and that is what happened during this downswing, as we had higher US equities as well. And a look at a final pair. Here's our Aussie US dollar, and overnight we slid down to 0.9160, which was close to our low on April 18th. But we recovered, and as gold prices also rallied, as well as oil. We had the Australian dollar move from this low up to 92.74 as a high for the day. The Aussie had been pressured overnight, as we had RBA Governor Glenn Stevens say that interest rates were pretty close to normal now. That lessened hopes that the RBA would continue to raise interest rates, perhaps even in their next meeting. However, the rebound in gold did help the Aussie to pare its overnight losses. Here is a quick look at gold prices, and we see that in today's trading, following some consolidation around 1,138, we slid lower, but then we boosted all the way to a new high for the week at 1,157, as we had some risk appetite return to the markets following Greece's announcement that it would formally request aid, and we had higher US equities to end the week. So that's it for our fundamental and market highlights. Let's take a look at what we can expect from the fundamental docket next week. In the US, we have data on consumer confidence both on Tuesday and on Friday. We have a testimony by Fed Chairman Bernanke, and on Wednesday we have the FOMC interest rate decision. Also on Friday we have the first version of GDP figures for the first quarter. Around the world, we get producer prices and consumer price data from Australia in the first half of the week, as well as the New Zealand interest rate decision. The UK posts a measure of retail sales early in the week, and then on Thursday, a measure of housing prices. which will be followed by Japanese end-of-the-month statistics like the unemployment rate, consumer prices, as well as a Bank of Japan interest rate meeting. On Friday from Germany, we also get retail sales. So that will do it for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you a great weekend.